Welcome to RBC's Markets in Motion podcast, recorded January 21st, 2025. I'm Lori Calvasina, head of U.S. Equity Strategy at RBC Capital Markets. The big things you need to know. First, the initial batch of 4Q earnings call commentary, which is mostly from financials, highlights the optimism and uncertainty that are both embedded in the current outlook for stocks. Second, investor sentiment on the AAII survey continued to slip last week despite stabilization in the S&P 500 itself. Third, we continue to see some signs of mild rotation affecting U.S. equity funds flows, where we continue to see a loss of momentum. At the same time, we are seeing improvement in flows to bond funds, global equity funds, and several categories of non-U.S. equity funds. If you'd like to hear more, here's another 5 minutes. Let's start with takeaway number one. Early reporters highlight the optimism and uncertainty that are both embedded in the current outlook for stocks. As our regular readers are well aware, our team spends a lot of time each reporting season combing through earnings call transcripts for S&P companies to get a boots-on-the-ground insight into the outlook and current backdrop for stocks. Here are a couple of things jumping out so far. On the macro backdrop, a number of companies have highlighted an increase in post-election optimism, but several have also highlighted an increase in uncertainty as the calendar has turned and called out the potential for sentiment or conditions to change quickly. Words used to describe the macro recently have included dynamic, complicated, complexity, and constructive, and one company noted that current optimism is being tested. Discussions of risk were front and center, with topics including U.S. domestic policy, geopolitics and war, cyber, and higher interest rates, should they be locked in. Issues fueling optimism included U.S. exceptionalism, strong economic growth, and AI. Not surprisingly, given the heavy dose of financials that have reported so far, there was a decent amount of discussion of M&A, where commentary was optimistic. This was still mostly in reference to pipelines and conversations, though some companies did suggest actual activity was starting to pick up a bit. Commentary on loan growth did seem more mixed. On the U.S. policy backdrop, financial companies highlighted the optimism that emerged post-election, and a few also noted that they had seen an increase in business activity around the event. At the same time, companies acknowledged the uncertainty that has also emerged around trade, tax, and immigration policy, which some suggested had contributed to the caution that had also emerged. Given the heavy representation of financials so far, we have read a lot of optimistic comments around regulation for the financial services industry. After regulation, tariffs have been the policy topic most in focus. There's been no major change in discussions of the consumer so far. Terms used to describe the consumer in recent calls, which appear to capture the view of most companies, have included healthy, confident, and stable, with spending referred to as solid, and interest in experiences and value-seeking behavior still in focus for some. Beyond the ongoing pressures of higher interest rates on consumers, other recurring thoughts in the discussion of interest rates in recent calls have included the idea that many of the banks are still baking in 1 to 2 cuts by the Fed in their 2025 outlooks. This stands in contrast to the view of RBC's rate strategy team that the Fed is likely done. Last week, we highlighted 6 questions we hope to gain insight on from 4Q reporting season, and at this point in time, it's fair to say that our questions haven't been fully answered, though we have gotten a little bit of color on a few of them. Moving on to takeaway number 2. Investor sentiment continued to slip last week as some green shoots for business confidence emerged. Given the importance of the idea that strong post-election vibes are a pillar of support for U.S. equities in 2025, we have been keeping a close eye on survey data tracking sentiment and economic activity. Here's what jumped out at us on this front last week. The bears now exceed the bulls by a wide margin on the weekly AAII investor survey. As of January 16th, the 4-week average for net bulls stood at minus 3.3%, with the weekly data point falling to minus 15.2%. This data tells us that the current period of stock market malaise may not be done just yet, as the 4-week average hasn't returned to 1 standard deviation below the long-term average, a level that helped mark the lows in U.S. equities in the fall of 2023. But the removal of froth in investor sentiment that was evident in this survey in October 2024 admittedly improves the setup for stocks over the next 6 to 12 months. Meanwhile, CapEx expectations did shoot up in the latest Philly Fed survey, supporting the idea that business sentiment is on the mend. Another data point from last week that supports the idea that business sentiment has improved is the continued improvement in small business optimism per NFIB. That indicator for December is now starting to approach past peaks, however. The NFIB survey also highlights the complexity of the vibes narrative in U.S. equity markets. Small business uncertainty continued to fall on this survey, but stayed somewhat elevated relative to history. And we'll wrap up with takeaway number 3. U.S. equity funds flows lose momentum, while global equity, non-U.S. equity, and bond funds see some improvement. We have been keeping a close eye on funds flow, which often show interesting shifts around the turn of the calendar year. What we're seeing so far points to some mild reallocations. Here's what we're seeing as of mid-January. U.S. equity flows continue to show a loss of momentum, as U.S. bond flows have bounced back strongly. Meanwhile, trends in equity flows look better outside U.S. dedicated funds, as a strong bounce back in flows to global equity funds appears to be underway, while trends to flows in Western European equity funds continue to show improvement in the form of less negative outflows. Improving trends and strong inflows can also be seen in a number of other non-U.S. developed market geographical categories. Within U.S. equities, both growth and value funds have seen outflows return, while inflows to blend funds have been moderating. Size-wise within the U.S., small-cap equity flows have also seen a sharp reversal and turn negative. Large-cap equity funds have seen a significant moderation in trend, but are still positive territory for now. Within small-cap, interestingly, we are actually seeing an improvement in flows to actively managed funds, which are positive. This has happened alongside, however, a weakening in passively managed small-cap funds, where flows have turned negative. We're actually seeing similar trends in place for U.S. large-cap funds flows, which have stayed positive in passively managed funds, but have also seen a sharp deterioration in trend there. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.